So welcome to another Complete Wealth Update. Today we're joined by Doug from Platinum. We're going to talk a little bit about what's happening in markets at the moment. Obviously there's been a lot of, extreme volatility is probably the only way to describe it. And it's always a good idea, I think, during these times to understand the dynamic of what's actually going on and how that actually does or doesn't, affect what our strategy and therefore what our action should be. So welcome, Doug, and thanks very much for joining us.
Good to see you, Matt. Thanks for having me in.
So you're obviously at home. You've been sort of caught in the shutdown scenario, and we've got some homeschooling and those sorts of things going on as well. So how are you finding the adjustments?
It's actually better than I thought it would be. I think our IT department did a fantastic job in the last couple of weeks preparing for this and accelerated things like getting on this chat thing called Slack, which has been fantastic for keeping in touch with multiple guys within the office. You get a different perspective on working and actually realize that you can get quite a lot done without the distractions of colleagues sitting next to you. So day 4 it is today, I think, and really adjusting. And I guess it's something a sacrifice we're all going to have to make to try and control the virus.
And so has it impacted the way the team works, do you think? Have you seen any noticeable impact in that activity?
I think it's interesting. Our team is generally, analysts are generally quite introverted people. So the job is to, I guess, reflect on what others are doing rather than necessarily to do. And so this Slack has actually been something that we've found a pretty intense level of communication. Probably hard to say if it's more communication than normal, but there's definitely a very intense level of communication. I think a lot of introverts like to express themselves through the written word rather than so much orally. So we're actually finding it very, very dynamic and a lot of communication happening, which is great.
Yeah, it's funny, isn't it? It's some people get a lot more honest when they're not face to face, and some people get a lot less detailed as well, because they don't want to sort of type things out. So it's an interesting, dynamical change in terms of communication as well.
Yeah, I think that's something we're basically operating off Zoom and Slack. I think what you notice in the morning meeting is maybe the hierarchy changes a little bit because people are slightly more anonymous, although their name still comes up. So again, some quite robust discussions, which is fantastic, which is exactly what our process is all about. I mean, ultimately, the way we think about investing, it's really a debate going on amongst a team of people about businesses and what they're doing and how they're changing. And that if it can be facilitated electronically, then I guess we can operate at our full potential while we're going through this situation.
So let's talk about that a little bit. Obviously, there's a lot at the moment going on from a volatility perspective. And a lot of people, I guess, especially those who aren't necessarily as experienced in markets, there's always this kind of first natural reaction of saying, well, why didn't someone foresee this, right? Surely, and in fact, you're now hearing about all the people who have, I suppose. And the way we kind of look at these things is, there's a million things that are foreseeable, the vast majority of which never actually come true. Well, not maybe in some parallel universe, but certainly, most of the experiences that we think might come true don't. We then move into what we call the realm of predictability, and that is, we can see something's, likely to happen, and we can measure the quantum of it, sort of thing. And so even if we can predict, who's going to win a sporting game or what the margin's going to be or all those sorts of things, we still need to be able to take action on it, right? So we still need to be able to say, well, can I therefore do something where the cost of doing so and the relative risk versus being successful versus, being unsuccessful means that I can profit from it, right? And how do Platinum approach that process from an investment decision?
Yeah, I mean, even if you take this specific example, it's interesting because, as you say, a lot of the media is now spotlighting the handful of people who told you this would be a bad situation. But we could see the data, as everybody else could, coming out of China, and that's going back to around Australia Day, I think it was, when you could see data coming out of China. And we took action immediately at that point because when these things, we have the experience. We've seen SARS before, we've seen swine, we've seen these various outbreaks before. But within a few days, and if you go back and look at the global data now, within a few days, it became clear that it looked like the Chinese had this under control. So having taken avertive action, we were kind of the view that it didn't look at that time like it was going to get much worse. So, and for us, the avertive action is generally using short positions. So we generally sell companies or indices that we don't own and try and profit from them selling. Within a few days, our view was, well, looks like it's being contained. We'll keep an eye on it, but there was no greater news. 2 weeks or 3 weeks later, it was about the 24th, I think it was, 24th of February in the morning, there was news, I think that by then it had reached Iran, Italy and Korea. At that point, we did exactly the same as we'd done when we heard the first news from China, which was take a chunk of money off the table, again using short selling. And as the data came through and suggested it was getting worse or spreading, we continued to take more and more money off the table, sort of ahead of the waves down in markets, if you like. So it's not something necessarily that you could predict in advance. We were dealing with the same information as others. This is the kind of situation that you'd have sat there in beginning of January and said, oh, I wonder whether there'll be a pandemic this year. But when you see data coming out and try and work out where that might lead, then of course one of the core things is to be in a position to take action and to try and adjust the position of the portfolio.
Yeah, but I guess it's important to look at, short selling as a concept. So that's where, you're selling something that you don't own yet with a view that will drop in price and therefore be able to buy it back in the future. So you're borrowing something essentially like an index or access to stock. And then in the future, you're going to buy that back at a lower price and you're going to sort of profit from the downturn. So that's often used as a trading strategy by many traders. Platinum, I know obviously that you use that type of strategy as a protection scenario. You're not looking to predict markets are going down and therefore profit from it. You're looking, well, if they go down and we own a whole heap of things that are exposed to the market, we don't want to not own them because they're good value or whatever. We want to protect in case that's the case. I guess it's also important for people to realise that with short selling is you are disproportionately penalised for being wrong, right? So if the market goes up, you get absolutely slaughtered on a short sell, right? So you want to be really careful about doing so. And so it's very easy to look at these situations and say, well, why didn't you do a lot more? And it's very easy to celebrate the people who did, right? So, these guys shorted the market or they did this in the GFC or the tech wreck or whatever. And you're hearing about them because they made a lot of money and everyone else who did that went broke, right? So you're not hearing about them. And so you get this kind of, again, this asymmetry of news and celebration. So it makes a lot of sense, obviously, from an investment perspective that, you'll use that sort of opportunity to protect, but you're very careful about not overdoing it because it can really, if there was a cure, it wasn't as bad as you were saying, then markets could have jumped, right?
Yeah. So, short selling over time, if you get a zero return from short selling over time, you're actually doing incredibly well because you're effectively getting the inverse of the return, if you like, from the stocks that you're short selling. So if you look at markets over time, they've probably gone up 7, 8, 9% per annum. Therefore, to get zero return from shorting, you're effectively having to buy or short sell stocks that are going up a lot less than the market. And there aren't many people who can beat the market by 7, 8 or 9% the other way, like by picking stocks that are going up. So to get nothing from shorting is actually very good. So what it does, it tends to just smooth the journey when you look at it over the long run. But in times like this, you do profit from it. It works like if you like an insurance policy, and you're being paid off in the crises. I think the important thing to go back to sort of January, February is markets were not cheap, and some markets were quite expensive. So if you looked at the US market, for example, and you looked at it back against its long history, it was near the top end of all sort of all-time ranges for where it's traded. So there was a reason to be cautious regardless of whether or not this virus came along. And in fact, during the last couple of years, I would say our performance has been held back by being cautious about areas of the market that have been going up despite already being expensive in our view. So it's been a difficult kind of environment for one who's taking a cautious approach to investing and not trying to lose their clients' capital. But when you get an event like this, you start to see the benefit of shorting, and there's a lot of nuances which we might sort of talk through. But the shorting of indices, the shorting of individual companies, and then it's looking for the companies as the sell-off unfolds that are holding up better than others, and trying to make a judgment as to whether or not these should also be falling or whether they are genuinely safe havens.
Yeah, okay. So, I mean, it's probably worth sort of just revisiting a little bit in terms of exactly what the underlying philosophy, if you like, that drives Platinum's behaviour, because what we find is, almost all investment managers, pretty much say the same thing. We buy quality companies, right? Or we buy quality companies at the right price. But no two analysts in the same manager do think the same way, right? So the definition of that's really, really important. So one of the key things, and one of the things that's always attracted us to Platinum is one of our key concepts, as we call it, mutual wealth assurance, right? Is that we want to invest our clients' money with people who are essentially investing their own money, and that, the majority of the long-term financial wealth of the people we're investing with is going to be as a result of how they look after their own money. And we're just along for that ride, as opposed to we're trying to find somebody who is trading something in a way or operating in some sort of way that if they beat something, they get paid for doing so, and therefore they're encouraged to take risks to do that.
Yeah. So, I mean, the key thing for us is always talking, and we use the word neglect for many years, that we're trying to buy things that we call neglected, but we found that that is a word that doesn't resonate with the end investor, because people don't want to invest in things that they think are neglected. However, it is what we do. So maybe we soften that by telling you we invest in things that are out of favor, but it's still hard for people to deal with. And it all comes back to sort of behavioral finance, crowd psychology, herd mentality, what have you. But one of my colleagues, Clay, who sort of runs 30% of the flagship portfolio, our international fund, I was with him in the US at the end of the year. And Clay would sit down with all these prospective, institutional investors who meet hundreds of managers from all around the world. And he would always start off by saying, we look to buy stocks more cheaply than their intrinsic value, which is what as you point to, every other fund manager in the world would say. They try and buy $1 for 90 cents, or however they want to describe it. But what Clay then would go on to say, which I thought was a very good way of expressing this, was how do we think there is a systematic way of finding these companies that are trading at less than their intrinsic value, or how do we think we can find the companies that are out of favor? And so the two ways in which you generally have a possibility of finding companies we think that are out of favor, and where we therefore then devote our energies to, is where there is some kind of short-term setback, some kind of transient thing going wrong for a business. And the second thing is where there is some significant change taking place. And often where there's significant change taking place, that's positive change. That's things of the likes of the difference an Amazon or a Google or a Facebook is making to the way we conduct business. There's a significant change, and it may not be the protagonist of change that you invest in, but it may lead you to either avoid certain companies or invest in certain other companies. So these are the two things that we really focus on: change and transient setbacks. And I guess this coronavirus, just to sort of follow from that, this coronavirus is probably a classic example of a transient feature, which we then have to assess and try and work out what that will cause for various companies, indeed for sectors of the economy, and even in countries.
Yeah, so I guess that's a great sort of explanation in terms of the process. I guess, from a perspective of motivation, right, I think that's another key thing to understand, is that are you doing that because you think by buying those companies is the way to make the most money, which is probably the default that most people think. Whereas the impression I've always got from you guys is that you start from that position because you're much less likely to lose money if you're paying, at or below price. So get those numbers, really, really right, and the direction really, really right. Not in the short term, but in the long term. And then from there, it allows you to make good money, as opposed to, no, we're trying to find the best opportunities to make money. We're trying to find the good opportunities to make money that are priced really well. Is that a better way to describe it?
Yeah, I think one of the things, and it's a lot of fund managers, a lot of the media as well, they're always asking guys for their very best ideas. It's like, what do you think is the stock that's going to go up the most or something? And it's like a longest drive competition in a golf course, for example. Who can hit the ball the furthest? There's a very big difference between hitting the ball the furthest to win a competition than there is consistently driving the ball a reasonably length down the fairway and having a good second shot to the green, if you like. And I think it's quite important, because what we believe is that if you invest in this way, you'll make a return from investing in undervalued securities, rather than making any statement on whether it will be the best return or not. Now, to make a statement as to this is the best opportunity out there, philosophically, you would actually have to assess every opportunity out there to determine it was the best. So we have a team of 35, 36 people. We have a limited capacity to analyze things. We have to allocate that resource, and therefore the skill is to allocate that resource to ideas that will generate a satisfactory return with a good look at the risk of loss, rather than setting up the team to try and find the best handful of ideas we can find in the world, which is probably a crapshoot at the end of the day.
Yeah, and it's also, the distribution curve is balanced, right? So for every possibility of this thing could be a 10 bagger this year, those opportunities are always the highest probability of going broke, right? So otherwise, that opportunity just kind of isn't there. And so it's very easy from a survivor bias perspective to say, well, if only I'd bought this back then. The one I used to like to use was Westfield back in 1960, when Westfield first floated, and Westfield being a spectacularly successful company and would have made any early investor essentially a multi-million, if not billionaire. But if you go back and read the press, around the early 60s of what Westfield was thought, similar to say Walmart in the US, they were nuts. No one's going to do this. Yeah. These guys are just going to blow up lots of money, and so it's always easy in hindsight to go back and saying, well, that was a really obvious idea now that it's successful. But you've got to have the idea in the first place. The execution obviously has got to be there as well.
Yeah, I think one of the things that's interesting is if you go back, a lot of people will try and unpick what Warren Buffett has done, and there's books and books written on how he invests. Now, he gives you lots of clues through his letters. He doesn't ever tell you exactly the formula. So people go away and try and back infer what he's done. I've found it quite interesting, again, in trying to describe what we do. We've lived now through, as a company, over 25 years. We had the GFC, we had the tech bubble and the subsequent bust. We had the whole resources boom and so on. We've had some pretty extreme environments condensed into that 25 years. So from that, you can, again, internally go back and as well as knowing what we do, you can actually use the data to sort of infer how we behave at extremes as well. And you can get a sense of, what is, we'll tell you what the most we're likely to put in a country is, for example. You can go back and you can test that, you can prove it, you can go back and you can look at the way the thing is built. The interesting thing is then the returns that we've made over time in different funds in different geographies all sort of cluster in a low double-digit range over the existence of the fund. So then you've got to sort of ask the question of how do you find companies that will give you that kind of return when markets only give you maybe 7, 8 or 9. And that's why we look for the things that are out of favor for some reason, or where there's some catalyst for change that the market's not picking up on.
Yeah, so from our perspective, one of the reasons why we've been a big supporter of Platinum over many years is because of that. We want to have confidence in what it is we own, right? So from our perspective and from our clients' perspective, we don't want to, no matter what happens, what the world or the markets throw at us, we don't want to sit there and be thinking, I wonder if what I own will continue to make the cash flow I need to live, right? Yeah. We want to be able to make those decisions, relatively when there's things, even when there's major things like this particular situation, but we want to make sure that what we own is real. What we own is likely on aggregate. There'll be some better than others, but on aggregate is likely to continue. And that way we don't have to really worry about it, right? And any other artificial form of structuring or, absolute return strategies or indexes or all these other things that can make money. There's no question they can make money and often will make more money. Regardless of what you invest in, there'll always be something doing better, right? So what we look at is that idea of saying, we want to have a high degree of confidence, and we especially want to have it in times like these. And I go back, probably the GFC was a good example, is, people looking at the GFC and saying, okay, well, what's this going to mean? And we were like, okay, well, the banking system blew up, right? But fortunately, by the time we'd heard that it had blown up, it had been kickstarted again. So things are going along okay. But it might take a while for that system to be rebuilt, and it did, right? But along the way, we kind of looked at it and said, okay, but if we own companies that do things that are needed, if the system that underpins that interaction between how values exchange changes completely, be it banking system, the fiat currency, whatever it may be, we still need to build stuff. We still need to, we still need efficiency and, drive from software or whatever. So there's still opportunities there that will make money. And so if we own those things, then we'll be better than most and we'll be okay. If we own what could have been great ideas that suddenly have just become irrelevant because we had a new payment system for banking and that's gone, then, as good an idea as that may have been, as the money it might have made us, we never want to own that thing because no business has a right to exist. It only exists because everyone agrees that we'll keep exchanging that value.
Yeah. I mean, this is one of the hardest things. As an analyst, you're trying to work out, build models and DCFs and predict what share prices are worth. But when it comes back to sort of simplest thing, the profit a company makes is a result of making something that people actually want to pay more for than it costs to make. So you've really got to understand that value proposition for a company rather than getting immersed too much in whether it makes 13, 14, 15% profit per annum. The real question is, does this company make something that people want? Can they make it more cheaply than people are willing to pay for it? And will that continue over time? And if that's not the case, then we have a problem because that company won't continue to make the profits that people are paying for it. When you deal with an event like what we're dealing with at the moment, like the coronavirus, it's not dissimilar to the GFC. So if you go back to, and this is our CIO, Andrew Clifford, spending a lot of time talking about this, at the moment, the input factors in high school economics that you get taught, land, labor, and capital, they're the three things that effectively are the resources that we use to then effectively build any business. What we've seen here is destruction of labor, if you like, or a removal of labor from the system. And as a result, with the lower level of economic inputs, we're going to have a lower level of economic outputs. That's the shock that we've had. And that's why today, regardless of the technical definition of the world is in recession. The politicians will probably find ways to deny that, but we are in recession around the world as we speak. The GFC was similar. There was a removal of the availability of capital, which was then whereby the system froze down in that regard. And as you pointed to, at some point after that, the system then gets back to normal. So there's a kind of reset, if you like. Now, with the coronavirus, then you can kind of sort of think this thing through logically. We've had to remove labor. People are working from home, therefore certain jobs like ours we can still do remotely. There are other jobs which require people to be physically together, and some companies will have chosen to close their operations. Businesses like travel, all the planes are on the ground, therefore people are being unfortunately laid off in that industry temporarily. So there are lots of disruptions that happen. The thing we know at the moment is there is no specific treatment. There's discussion about a couple of drugs as to whether or not they'll be effective. There is no vaccine, and there is testing. That's probably the three main components of medicine. So the only way at the moment we can stop the spread of this is for people to interact less. Therefore, we've got that shock to labour. Now, a number of things could happen from here, and if we look at the numbers from Hubei in China, the lockdowns happened on the 23rd of January. The deaths peaked about 21 days later, I think it was, from that point, and then started to fade after that. And as we speak, it looks like they're starting to loosen the restrictions in China. So if that is the path, we now have some sense of what that path might look like, with upside surprise if we get some kind of cure or vaccine presented to us in the near term. But when we look at the medium to long term, we can start to say, well, this is a transient feature. This is a setback. What will businesses look like 3, 4, 5 years from now? There will be businesses which will be casualties of the shutdown. So in aggregate, the system will probably be fine in a year's time. However, if you came into this event with more debt than was sensible, or with a business that unfortunately you couldn't have predicted, for example, running a successful cafe that an entire office block was going to be shut down. But there will be businesses which will unfortunately be casualties of this. One of the roles of government in this situation is to try and reallocate the pain as it's taken, and that's what some of the stimulus packages will do. Some successfully, some less so. But we can move from thinking this is Armageddon to markets have corrected by of the order of 40% in a lot of countries, which is huge. We saw that in GFC and tech bubble. They probably went down 50. So we've already had a huge correction. We know the system will get back to normal at some point in the future, and we can move from a protective mindset to one of what are the opportunities that this is throwing up.
Yeah, but I guess different to some degree with if I can look at the GFC and the tech wreck, and obviously we've got the data coming out of that now that we've been able to sort of pour over for a long time. And what is to me clearly different about those two events is that it was also a resetting of a significant amount of misallocation of capital in both of those cases, right? So if you go to the tech wreck, there was just money chasing nothing. We went from money chasing, good businesses to great ideas to sort of thought bubbles to just absolute fantasies, right? Yeah. And so there just wasn't that money, right? So that was of that sort of 50% or whatever it was in terms of total correction there. The vast majority of that was just insanity, just being removed from the system. A similar amount of that, maybe not the same quantum, but leading into the GFC, credit markets were clearly crazy. There was a cavalier approach to risk because there was too much separation between the person taking the risk and the person who was the risk, and so no one cared, and so that created a bubble in itself, which infected a lot of other things as a result of that. The problem with this one is I see you can go one of two ways. One is you talk about that sort of labour being removed from the market. Labour is very malleable, very aggressive because the deployment of human capital is what drives the vast majority of people's personal economics, right? So they'll get back to they'll do anything as soon as they can. Yeah. And unlike even say if we go back to the Great Depression, the ability these days in a modern world with the resources and the technology and things we have, it's very, very easy now, better than it's ever been before, to turn an idea into money really quickly. In fact, with virtually no capital. So there's a potential of that sort of huge bounce. I think the downside and the danger is if you remove that and you sort of shove her into their homes for 6 months, the social impact of that is going to create a very weird dynamic. And I think that could potentially be, if I was looking for what could be a huge downside, that could. Do you guys consider that at all? Is that something that you try to predict in terms of societal behavioural patterns, or you do really just look at it from a company perspective?
I mean, it's probably early days to be trying to make strong conclusions on what this means. I mean, if you look at Australia, but what we had today, Thursday, and last Friday, there were more people on Bondi Beach than there were on a public holiday. So I don't think we've made. We've spent 3 or 4 days at home. We haven't sort of re-engineered the whole system, and anecdotally, I think quite a lot of people aren't taking it as seriously as they should at this point. This is a situation, and it's hard. I mean, it's hard to make firm predictions on this, but it does look like once you lock down properly, that you stop the spread of the virus almost instantaneously. That's showing up in the data as far as I can see it. The death data from Italy, it showed up in Iran, it showed up in China previously. So I don't know what that duration is of the lockdown, and it's very hard to really monitor this consistently across countries. But it's equivalent of people taking a longish break, I think, rather than that entire re-engineering. I think we'll find through this period, we'll develop some new habits that maybe mean we're more comfortable doing this interview, for example, remotely rather than physically. We may change the way in which we, the whole concept of flexible working, which is something that people previously thought perhaps meant you were slacking off. Maybe people will realize that having a day at home and getting a lot done is actually a helpful part of the working week and so on. So I'm hopeful, maybe I'm an optimist, but I'm hopeful that over the next few weeks, we can pick up some new ways of doing things. And those who are unfortunately out of work as a result of this, that I'm hoping that it is a transient thing and sort of as we get back to normal, the jobs that were there before sort of reappear. Now, they may reappear in different forms. There may be some shifts that take place, and that's what we have to try and think through as investors. If you take the extreme examples, do we want to invest in an airline right now? That might be a difficult thing to do because depending on how long this lasts, there's a risk for the solvency of various airlines, but I don't think there's a risk to these airplanes themselves being deployed on the other side. So while you may not want to own the airline, you may still be comfortable owning the assets in the airline industry that will be utilized again come the other side. So it's a very interesting thing to think about, but it's very early to be making big conclusions, I think.
Yeah. Okay. Cautious approach is always a good idea, I suppose, especially when the risks, again, they're very asymmetric, right? So one of the things we try and make sure our clients understand is where you really lose money in the long term is where you're not participating in a rising market. If you're in a market that falls and will ultimately recover, as they all do, you haven't actually lost anything. You've lost the opportunity to maybe have benefited from the downside, but the sidelines are littered with people who tried to do that. Where you do lose money is where you have substantial capital on the sideline when the market never comes back to this level again, sort of thing. So that participation is really important.
Yes, I mean, I think what you can do at this point in time is you can start to think about there are companies which have, if markets have fallen 30, 40, 50, and they have pretty much around the world, there will then be companies which have fallen by 50, 60, 70, 80. And these are incredible setbacks. Now, obviously, in certain situations, it appears logical at first, airlines being one example, where the entire fleet has been grounded. But what we then need to look at is, of these companies, which ones are still strong businesses, don't have too much debt, and are these giving us the chances to start thinking about building positions in companies that will be. So it comes back to what we do at any point in the cycle is, will this company be stronger in 3, 4, 5 years' time than it is today, given the price that I'm having to pay for it just now? And I suspect that as we look through that, this will become a period where we find opportunity. But I don't think we suddenly go from markets falling as sharply as they have to not going through a period of sort of digestion and somewhat fear, if you like, about where we're going.
Yeah, look, it similar to the GFC, I suppose. Even if it turns out not to be anywhere near as structurally significant, it's going to be quite some time before we have a reasonable appreciation of that, and so it's reasonable to assume that there'll be some huge up days in the market because there'll be continuing to be huge down days, and I guess it's accumulation again. That kind of availability bias and particularly recency bias. If you're seeing the news on the days the market went down, and you're missing the news, like yesterday it went up a few percent, the day, but you didn't catch the news yesterday. You caught it the day before when it was down 5. Yeah. You can start to, and also we feel the negative like twice the positive, right? So even just a pure weight of information, people can find, over a period of time the market's gone sideways, but they feel like it's been a disaster, right? Because the combination of that news. So a lot of those behavioral kind of finance and behavioral psychology concepts are really important to appreciate during these periods, because at the end of the day, and I know you're a huge student of this, but you're not immune to them just because you know about them, right?
No. I think everyone has the same natural response, and I think we often talk about the best ideas that we have are the most uncomfortable ones. So back to that point we made earlier around here are our top picks or the high conviction concepts. Look, what we find is that the ones that end up being the biggest sort of internal battles, both internal to the person and then internal within the team, often end up being the best because we're taking on the market, and we've got to respect that the market's pretty good at pricing assets. So for us to take a different view, you are having to sort of go out on a limb to start with. There's loads of behavioral things that sort of come into play here. You mentioned this idea that we feel losses more than we enjoy gains, and it's the interesting thing if you look at tables which are being sent around at the moment of the worst days in markets and the best days in markets, you'll find that often the best day is one day after the worst days. So you get these -10s and then back 9s and stuff. So you don't tend to get the best days in markets in good environments. They actually tend to be near the bottom or a long way into bear market. So the losses and gains is important. The other one is phase myopia, which I've been talking a bit about, and it was interesting. We did a roadshow, which I think you came along to last week or the week before, Matt. We were in at the beginning of the roadshow. We were putting together what we wanted to talk about ahead of coronavirus, and one of the things was at that point we were observing quite a lot of heat in a number of areas of the market. So a lot of growth stocks, a lot of defensive stocks had been bid up as sort of in a world of very, very low interest rates. And without going through into too much detail there, people had been clustering into either companies that looked very safe or companies that looked like they were growing very, very quickly. So I wanted to talk about this idea of in bull markets, we tend to present an ever more extravagant view of the future. And what happens with phase myopia is the longer we get into bull market, the further and further out people are looking to justify the investments that they're making. Ironically, we've gone from bull market to bear market in 3 weeks, and the phase myopia lesson flipped around and became really one about how you feel right now, because in a bear market, your perspective really closes up and people look at the risks of what could go wrong in the next, can even be month, week, day, and that consumes them. And so the behavioral trick here, if you like, is when we're in that ever extended view of the bull market, you want to start focusing on what could go wrong near term. And then in the bear markets, when people are looking at what can go wrong near term, you want to start asking yourself what might go right in the longer term. And then you might find some opportunities that others aren't looking at.
Yeah, look, I think that's a pretty good way to sort of wrap it up. I go back to that key thing for us is having confidence in what you own, and that point you made earlier about economies are a made up concept, right? All an economy is we've agreed to exchange value between each other, and so we first have to create that value by deploying, as you say, the land and the capital and the labour, or what we would call human capital. And if that's being deployed in a way where people can create value and then they're free to exchange it, then that's all an economy really is. And so the ability to bounce back to some more normal version of that in the short term will be there once the medical danger is at least abated to a fair degree. And so the risk we see, we have no idea because we have less idea than you, and you've got no idea when that will happen. But we want to make sure that during these periods we were prepared for them by being confident in what we own before they come, because again, even if we think we can predict them, it's the math is penalise you, as we talked about with short selling, penalises you for getting things wrong that didn't occur as much as the other way around. So having confidence what you own and making sure that you can stick to that strategy is what always sort of gets us through. So I want to thank you for your time. I know you're a very busy man at the moment, a lot of calls. Enjoy your homeschooling. Hopefully your kids have got plenty of things left to teach you. And we look forward to catching up with you again when face-to-face at some point in the future.
Well, thanks, Matt. Look, I think the important thing really to take away here is we're going through a process, and the market will anticipate a recovery or return to work at some point. The important thing for now in Australia is we've just started the process, and I think people just need to follow the idea of washing your hands and keeping your distance, and that will reduce the time that we have to spend in captivity. So thanks, Matt, for having me on, and again, I look forward to seeing you later in the year physically as well. Take care.
Thanks, Doug. Thanks. And as always, if you've got any questions, you know where to find us. Send us an email or give your advisor a call. And we appreciate you dialing in for today. Thanks.